As a beginner, how should I approach the stock market and make my first investment?
So in India, there are many young investors, and they are starting and beginning to invest just right now because millennial population and young population is just kind of warming up to the idea of stock market. So in the early stages, for any investor, whether young or old, the experience is very tough because firstly, most people make money immediately after coming a first few trades, mostly by luck and so, and that is easily confused with skill basically, which is indeed luck. So if there is this clarity of luck and skill, it is actually very helpful going ahead in the journey. So once a person kind of starts making initial trades without not much knowledge and not doing research, it's important that they don't confuse it with like skill and then don't become overconfident about it, because the next trades that they make are most likely going to be loss making, which is the general experience for everybody. So the first recommendation that we make to all initial investors is that to do proper research. And so then this follow-up question comes in, so what should I do, how should I do research then? So one is books. I mean, that's my favorite, and I have a bias towards reading books and getting research from there. Of course, apart from research through books, there's a lot of videos and online material that's also today available about stocks. Of course, theoretical knowledge and practical knowledge is very, very different because what you read may not always be true in the market, but that's a great start. So doing proper research through whatever source possible, and a reliable source preferably, is super helpful in terms of starting out. And the first investment is really crucial because that sets the tone and the entire experience going ahead. So initially, if you make losses, there are many people who just gave up basically, right? That no, market is not for me, it's a gamble, I didn't make money, so it's not great, let me not invest. So, and on the same side, people who made initial money also have a wrong expectation that I'll keep making such money in every trade and stock market is easy, I'll make a lot of money. So it sets the tone. So unless you do proper research before that, it's not a great idea to make a first investment. On the flip side, there's another small option which we call tracking shares or tracking investment basically, which is buying a small token number of shares to get your interest into the stock. So say you are reading about a company, say named ABC, for example. So if you directly go and read about it, you may not be interested. So you put a small amount of money into the stock, very small, whatever is small depending on your income and savings, and then start reading about it. Your interest will actually increase because you'll be tracking that stock, and then you'll want to read more. And if it's good, you want to invest more, or you want to get out of the stock, it's not good, right? So that's also a small thing. But again, the tracking amount should not be huge. Otherwise, it might lead to losses. So as a summary, the first investment must be preceded by proper research. And how that research happens and all, like I said, there's a lot of material. And on our Savart blog as well, we are trying to do our best in terms of educating people on how to do their own research. So going ahead, we have some good plans for that as well.
What are some of the most common stock market myths and misconceptions that you encountered?
So the number one myth, or the most popular myth that I come across very frequently is many people feel that investing in penny stocks or stocks with a small share price actually gives higher growth. So first thing, there is a simple formula of market capitalization, the share price into number of outstanding shares. So just by looking at share price of a company, you can't say and comment about the size of the company. So there could be a very big company with whose share price is low, and there could be a very small company whose also share price is high. It actually depends on the number of outstanding shares also. So many people ask us, okay, why are you recommending shares which are priced more than 500? It actually is not very logical, because the share price does not have anything to do with the growth potential. That number itself, of course share price is important, but not the number itself. The underlying valuation metrics, how it is linked to the business, how are the fundamentals, of course that is linked to the growth potential of the business. So what we want to communicate there is that not to look at just the share price, but look at the valuation, look at the fundamentals, quality of management, quality of business, growth potential of that industry sector, how is the product like, what are the customers of the business saying. So these things actually drive the share price. And to think that only a penny stock can become a 100 bagger or a 50 bagger or a multi bagger, which is called in the market, is wrong. Even a company that is share price is priced high in terms of number, not the valuation metric, can also grow basically. And there's so many of that those kind of examples in the market. And A small trick to also work around this myth is that you always do the calculation in percentage terms. So for example, a stock price at 2 rupees is if you think it will move to 4 rupees, it's don't look at it as just a 2 rupees move. It's 100% increase in the value of that company if it happens. Same thing, a company priced whose share price is priced at 25,000 rupees to move to 50,000, that's also a 100% increase. So if you look at it from a percentage metric, you can just get around that. From a mathematical perspective, you can wrap around that concept to begin with. And once these slightly technical things like market capitalization and how a company is valued in the first place, right? If you look into those basic formulas, that myth will be kind of busted. And second, in terms of starting out with the investment, right? Most people think investment requires a lot of capital. Unless I have a few lakhs or crores of rupees, I can't invest into the market, which is not the case. There's so many applications and investment platforms and mutual funds that offer even at 100 rupees or a 200 rupee investment. So don't need large capital to start. Large and small is a factor of how much your saving and income is. Somebody thinks 100 rupees large, somebody thinks it's small. It depends on your personal finance basically. Apart from that, there is no restriction. And the last misconception about market is that there are a few blue chip stocks which have kind of already grown so much in value, and there is nothing actually called a blue chip category which is officially recognized all over the world. It's just a thing. It's just a word that we use while discussing a stock market in general, right? It's just a term. It doesn't have a real definition of blue chip. What is blue chip stock? So they have already run up in value. They are not going to run up in the future. And we want some exotic stock to invest which nobody has heard of. I want to discover that invest. I mean, investing is not like that simple. You need to look at the business metrics of it. If a company has done well at a 20-25% CAGR, businesses like Kotak Mahindra and all, right? It is important to see whether they also have growth potential in the future. Does not mean that if 25 years they have already grown, they can't grow in the future, right? Not just this is just an example. There's so many other companies like that. So just by size or just because it's a blue chip doesn't have a growth potential. So this is linked to the first myth that I said, but it's not just linked to the share price, but also the size of the company. Big companies don't grow enough. Small companies grow well. Wrong. But small companies can also go down to zero very quickly. Right? And of course, even big companies can go bankrupt. So all possibilities are there for all kinds of companies. The only thing is that blue chip companies have better cash flows and better cash reserves to weather through storms. That too, not all companies, some companies. So it's a very specific thing and it should not be generalized. So these three myths, I think, are the most common thing that we encountered.
How can I protect my stock market portfolio during the market fall?
So market fall or a recession or a crash or a correction, these are different names for a market fall, and these keep happening very regularly. So it is nothing that should be very surprising basically. Oh, market fell and there's a recession basically. It's the general nature of the market. So markets are like pendulum, right? So it goes to extremes, reverts back to mean, and then goes to extremes and then revert back to mean. So it keeps on happening basically. It's the only difference is that sometimes the swing is very extreme, sometimes it is not high, right? But even when during good times market goes the other way, and the bad times also market goes the other way. So recessions must be considered as a general way of life for all investors basically. So there's number one, there's no element of surprise. This happened. And second, most of the market always tries to assign reasons to it. Okay, market fell because of this geopolitical concern. It fell because of inflation. It fell because of some interest rate hike. It's not always the case. And even if it were true, how do you prove it basically? So rather than chasing the reasons behind that, of course, we need to do research on that. But I feel most likely it's a futile exercise. Apart from gaining knowledge and taking certain steps, if we know the reason ever of why market crashed, the most amount of focus and time should actually go on solving it and being prepared for it at all times. Now, being prepared is often confused with the bearish kind of investors, right? Okay, it's going to fall tomorrow, day after tomorrow, next year it will fall, this year it will crash, after 5 years it will crash. No, nobody is actually able to predict that much. And what I have observed maybe the data would be better if you use data to kind of come to that conclusion. But what I've observed is, when a large number of people that say that something is going to happen, it actually doesn't happen. So when everybody is prepared for a recession, for example, the best example is the 2020, the COVID fall, right? COVID induced fall, or whatever the reason, the market fell during that time. lot of doom and gloom kind of situation was there, like next 10 years or 5 years market may not recover. Yeah, and I read certain articles which said market could go down to zero also, like literally that much gloom was there. And in a couple of months or in for a year, basically at least the market rebounded. Of course the economy and market are not always linked in the short term, and they don't represent each other accurately, but the markets recovered. And now when it was recovering, then there was the other extreme, that it is going to go on forever. 23,000, 24,000 will hit with the indices and all that stuff. So again now it's fall. So rather than prediction, being prepared for it is better. How can you be prepared with a market fall? One is maintain a small cash position whenever you can. So rather than being 100% invested in the market, always maintain a cash position. And again, always is also wrong, because again sometimes you need all the cash to be invested when there are good opportunities. But at Savart, what we do is we maintain a healthy cash position at most of the times, so that if the market falls, we have enough cash to go and enter into the market. Because say I have 100 rupees and I've invested all the 100, and today market fell, and say my portfolio went down to 75, and I don't have cash to invest. All you can do is just watch. Oh, okay, let's the markets recover, then we'll look at it. But if you have cash, the same investment that you purchased at 100 rupees as a portfolio, you can buy the same thing at 75 now. If it was a really good portfolio, it's like a discount. So why don't you go and buy it? But what most investors do is do the opposite. When it's at a discount, they go and sell it because, oh, it's fallen 25%, I can't take the loss. So the first thing, again, this is a slight digression, but anybody who enters a market must at least have a 25-30% kind of a risk bearing capacity. They must be able to lose 25-30%. So if they're not ready, stocks are not kind of the best asset class to be in, basic. So maintaining coming back, so cash position and having that risk taking capacity and having the emotional calm during market fall. And then again, proper research. If your companies were not good, and once those stock fall, most likely they may not recover ever if they were not of good quality. Of course, if they're good quality, then you will see a rebound. You don't need to do much, basically. Trick that I do for myself is I don't watch markets too often, basically. For the once I invest into a particular portfolio, I don't watch it daily, because if I watch it daily, I want to do some action. Okay, sell this, oh, buy that, something I want to do. It's like urge to be active, basically, with the portfolio. If I don't look at it, I'm focused on something else, and then I'm cool, basically. So that's also a small trick which I use during market falls. And when I watch it, I keep some cash ready to actually put it back into the market, especially when market falls.